All right, here we go. So really quick, what is macroeconomics? So it is a branch of economics that studies behavior and performance as of the economy as a whole. So there's multiple moving pieces. Five principal ones are economic output, so GDP, and economic growth, employment, inflation, highlighted because that is like the word of this decade, and investment. So here's the thing. Why do macroeconomics matter? Why are we talking about them? Well, they matter a lot. They matter a lot in decision making as business owners and just as people who live in the world. Like there's some fundamentals that we want to understand. Things like, should I buy or rent a house? Where can I safely invest my money at any point in the cycle? Because macro cycles, should I expand my business? If you're a business owner, when is a good time to do that? Like, should I resign? Do I want to go into entrepreneurship? Lots of decisions that we make personally and professionally have to do with macroeconomics. Oops. So the key to making those decisions really sits in the economy. So we might ask other questions like, well, are we still growing? Is the economy growing? Is a recession coming? Like we have a hot war. We have an economic war, like a trade war. Is this, are the markets crashing? Well, every single day they crash and they rebound. So that's like a whole other story. But there's a lot of talk about Fed rate hikes. And we're going to get into all of that because these are the issues that are front and center, and probably macroeconomics have really shown themselves in our lives or in our awareness in the past 2 years more than they have for most of us ever. We probably didn't pay attention so much until now, and it's because of where we are in the cycle. So headlines make it look pretty grim out there. There's a lot of inflation, Americans living paycheck to paycheck, including six-figure earners, especially if you live in California or New York. So, inflation has been taking a toll. We see a lot of this in the stock market. So we see these big flashy headlines, it's crashing, everything is plunging, the global house price slump is coming. I mean, everything is about to go topsy-turvy over and out, right? Like this is what we see a lot in the headlines. Now, there's data in macro, and like this is where we want to focus because headlines are not information. The media headlines, I don't care where you read them, they are not meant to inform. They are meant to elicit an emotional reaction to make you do something that usually is not in your best interest. So given a lot of these headlines, what the heck happened? So this is where macro takes center stage. So what happened over the past couple of years is that there's been unprecedented fiscal monetary stimulus. So 40% of all dollars have been printed into existence in the past 2 years, 40% of all money. And I will also say there's never been as much money in the world, literally, nor as much poverty. So when we talk about and think about scarcity and abundance, this is why understanding macro is important. This is the system that we're in. And this is why we spend so much time informing you about it so you can make better decisions, right? So this much money into the system has a massive influence, and we don't always see it right away. When you put trillions of dollars into the economy, the way that the economy works with the money flowing through central banks to the big banks and then down, there is a lag in what happens. So that's one thing. So all this extra money. Secondly, with the economy, the global economy shutting down, we had a just-in-time system of global trade. So it was not built for resiliency. It was built for efficiency until everything shut down. So you have a supply side shock. With China's ongoing zero COVID policies and the war in Ukraine, that supply side shock continues. So you have all this extra money and then you have less product. So when you have a lot of money chasing less product, supply and demand means that product price goes up substantially, a lot. And that's what we're seeing. That is really what's causing inflation. It's multiple factors. So the other huge piece of inflation, and we'll look at this when we look at what makes up inflation, what makes up CPI rather, is that there was a very sudden demand for homes and migration to new markets during the pandemic. And at the same time, historically low interest rates. So it was very cheap to borrow large amounts of money, and everybody was doing it. So it pushed this housing boom, which pushed housing prices up, which added to now what you see in the headlines of like the housing market is crashing, all of this. Relatively speaking, it is not crashing. It is reverting to a mean. Two very different things to be aware of. But all of this caused affordability issues, which were already an issue because we've been undersupplied in housing construction for the past 10 years. So, in other words, what happened? We added money. It flowed through the economy that needed to be spent. The cost of energy skyrocketed, especially petroleum, and not just gas at the gas station, but petroleum to move ships and trucks. And everything that makes up the global supply chain system. Cost of housing went up. Cost of rent went up a lot. Something I know a lot about for what I do professionally. The job market bounced back. It lifted wages, and these very strongly, still relatively strong. And then consumer demand for goods and services went through the roof. And so we didn't have enough people to fill the jobs for the demand. So what happened is inflation got way out of control. And inflation became, and still is, public enemy number one. So inflation is the loss of purchasing power of a given currency over time. So what it means is that a dollar is worth more today than it is tomorrow. Which fuels more inflation, because if you know your dollars are worth less later, or rather if the price of something is going to go up later, you're going to buy it now. So it's like this self-fulfilling prophecy. The only good thing about inflation is that it makes your fixed rate long-term debt go away. That's the only good thing about slightly higher inflation than what the Fed sets out as their target, which is 2%. But it's rising prices over time, and there is a healthy amount of inflation. That's the Fed's 2% target. And we'll talk about the Fed in a minute. So strong economy, energy prices, government policy. So again, government policy, hey, let's just make a bunch of money. Well, that causes inflation. That's monetary inflation. And it's measured by something called the Consumer Price Index. You've probably seen this. It's a basket of goods, goods and services. Then there's core, and then there's food and energy. And so there's different pieces of information that go into CPI, which tell us what inflation is. And so you have higher paychecks, generally speaking. Like I said, it helps borrowers, but the negatives is that, especially if inflation starts to get out of control, it can lead to a whole host of problems. And this is why inflation is public enemy number one. So this is the year over year change. Now, I'm not going to go too much into it, but just so you understand, if you look at the top here where it says fuel oil, that is close to 80% higher year over year from July. Now, some of these things are coming back a little bit, but these are the components of CPI. And you can see how much certain components have gone much higher than others. And we had, let me just see if it's over here. I'll get into it later, like the way that inflation is moving and it's tracked from this basket. But you can see the components. You can see what's causing or what has the highest changes in price. And we've all experienced this in different ways. So this is CPI. Inflation you can see this is a big piece of core inflation. So you'll hear core inflation, which excludes food and fuel, essentially food and gasoline, because those can be very volatile, especially gasoline. But a big piece of inflation has been the cost of housing. I mean, it's a huge component. And shelter still moved up in October, even though inflation for the most part came down, shelter still went up. Now, real estate lags interest rate changes. So it can take up to 18 months. Sometimes it can take 2 years for policy to actually have an impact in certain markets. And so what you can see here is that we had a peak in 2022 of house prices. But just because it's going down, and this is really important, I really want you to understand this, just because it's going down, A, doesn't mean it's crashing, and B, doesn't mean it's still cheap. Because if you look at this purple line, everything's still going up. It's still up from 2020. It's still up from 2019. So it's coming down. Great. It should come down. It was out of control, but it's not, unless there's an actual true crash, which is highly unlikely given all the rest of the things that are going on. It's really important to understand like just how much prices for housing have gone up. And that's been a major component to inflation. So again, this is the rents. This is shelter CPI. So you can see that, yeah, it's kind of coming down on the curve here, and that's good. We want to see inflation start to come down because it's been at a 40-year high. I mean, it hit 9% in June, which was its peak. And so it's coming down, but it's still really high. Still really high. I mean, we've seen 40, 50% rent increases in certain markets. So we're still on this track of like, well, what happened? So if you've heard of this wage price spiral with a really tight labor market, so like the lowest unemployment also that we've had, workers can demand more money. And they have been. There's the Great Resignation. So you have the Great Migration. You have people that were living in gateway cities moving to tertiary markets with their big salaries. So they were also, maybe they were taking pay cuts, but even then, probably not. So they're still making lots of money. You have people changing jobs. You have service workers in demand. There's help wanted signs everywhere. There's been a return to spending. So you have the consumer being really active and wanting to spend because everyone, through the pandemic, we weren't spending as much. Lack of labor, supply shortages, the wage price spiral. Technically defined as a prolonged loop in which inflation leads to higher wage growth that fuels even higher inflation. Because if you have to pay your workers more, you're going to raise your prices and so on and so forth. That's not the kind of spiral that we want. So I read these off before, but here's what happened. The Fed got it wrong. The Federal Reserve Board that is responsible for setting base interest rates at which banks lend and borrow money to each other and governments as well. Their initial view that inflation was transitory was so wrong. It was so wrong that they had to take extreme action, and they took it really late. They started taking that action in the spring of 2022. And so this unprecedented action is that they've been hiking interest rates at very high pace. So the Federal Reserve is America's central bank. And central banks generally in every country, because the monetary system works through fiat. So it's not asset backed. It's responsible for conducting monetary policy and controlling the money supply. So the Federal Reserve has a dual mandate. So their dual mandate is to pursue economic goals of maximum employment and price stability. And price stability basically means inflation. So the Fed at any given point in time wants to balance employment with inflation. So back to that wage price spiral, if it goes out of control, everything goes out of control. We're in a world of trouble. You see this in third world countries, Argentina, Brazil, you see this like massive inflation and, 30%, 30% of the population being homeless, like, and like loaves of bread cost $100 because that is what's happening with a system of money that can be printed into existence basically on a whim. Now, the fiat system is like a whole other discussion, but the way that the Fed does this is with tools. They have multiple tools, but their biggest tools are controlling this money supply, so how much money they make available, and then interest rates. So sometimes, like right now in this moment in time, one of the things that they do to try to get employment and inflation at some kind of a balance is that they have to engineer a recession. And it might seem odd to think that why would anybody want a recession? But in a highly inflationary environment, the Fed wants a recession because they need more unemployed people and they need people to stop spending money because inflation is destructive and they have to do some destroying of their own, which is called demand destruction. So higher interest rates, if you're a business owner, and a homeowner, but let's say as a business owner, if you need to borrow money to run your business, which most corporations, most businesses do, if it costs you more to borrow so that you can expand, you won't, right? And so it makes you invest less and try to really cut your costs. So higher rates are meant to deter spending. Higher rates are causing higher mortgage payments, which makes it a little harder to get a house. So it brings the house prices down, again, on a lag. But right now, we can get into this, but the other thing that is being destroyed right now is asset prices, is stock markets. So you have a lot of asset destruction. And so it's not just investment that is deterred by higher interest rates, but in essence, all this money that was printed over the past couple of years, a lot of that money went into the stock market because the way the system works is that banks borrow the money, they lend it to, hedge funds, institutional investors, et cetera. They get that first and they get it cheaper than everyone. And they turn around and they invest it so they can leverage it and make the most money. By the time we get it, they already bought everything. And so now what's happening, and you might have seen these headlines where you have all these billionaires that, they've lost like a third of their wealth or half their wealth, paper wealth, right? Because their stock prices are down. Like Facebook stock was down like 70% at one point this year. So you have this wealth destruction, but it also affects people like me and you, right? Like if I invested in the stock market, I don't care if Mark Zuckerberg is no longer worth, whatever, or what's his face? Bezos worth like $130 billion or something. I'm not going to cry over his loss of wealth. But it really hurts us. And this is this like trickle down waterfall effect of the way the current financial system works. So this is what the Fed is engineering with their rate hikes. So we hear about these Fed rate hikes and they really matter. So you have in March of this year, kind of out of nowhere, the Fed started to raise rates. Now, this has happened before in the 70s. But in the 70s, interest went up to like 18%. That was a different time. Like we didn't have national debt to GDP being 130%. It was very different. So nobody's seeing 18% interest rates anytime in the near future. But what's been similarly aggressive is how fast and how hard they've come at this. Like no one expected at the beginning of the year, the markets, it's called the forward curve. Nobody expected this, the rates to go up this fast, this aggressively. And so they've really shocked markets because the Fed is trying really hard to get inflation under control. So you can see that they're trying to do this by raising rates. And then the summer they started raising by 75 basis points, which is a lot. And they've done that 3 times in a row. So in essence, the days of cheap and easy money are gone. So this is where we were. I call this the YOLO trade, the you only live once trade. We all came out of the pandemic and we were like, F it. I'm going to live my life. I'm going to have a good time. I'm going to build. I'm going to invest. The markets, everybody, they were all like, let's go. Okay. This is where we're going into 2023, because the Fed was not bluffing. Jay Powell was not bluffing when he said he wants to get inflation under control. And it really matters to understand what the Fed is up to. So the rising cost of money. So as inflation rages, and it's starting to come down, we'll talk about that in a minute, inflation is still outpacing wage growth. And so what's been happening is that there was a lot of savings that happened, especially in 2020, the second half of 2020 with the pandemic, is that people were home, they weren't spending. So they had all these savings, which was great. All those savings are gone. Credit card usage is back up. Credit card debt is starting to hit record levels. And it's not necessarily because people are spending more, but it's also because things cost more. And so you start to see this knock-on effect. So money costs more. It costs more to borrow. Your credit cards are going to cost a lot more. So we'll talk about variable rate debt here in a second. The other thing is how interest rates. So when I'm talking about rising cost of money, as the Fed raises rates, anything that is interest rate sensitive, any kind of credit, unless it's fixed, unless you set a fixed rate, like my 30-year mortgage, I mean, you're going to have to kill me to get my 30-year mortgage that I got in 2020 because it's so low. And this is part of the home buyer problem that we'll talk about in a second, is that unless you have really low rate fixed debt, anything that's variable, credit cards, HELOCs, et cetera, every time the Fed raises rates, that debt goes up. It costs you more to use your credit cards, to use your revolving lines of credit. And if you have an adjustable rate mortgage of any kind, it's going to cost you more. So as interest rates go up, the cost of borrowing, and when the biggest asset you're ever going to borrow against is going to be your home. So here's what happened in the past couple of years. Here's where inflation and interest rates have had a massive impact, which goes into that CPI number, et cetera, et cetera. You can see how it all pieces together. So in the first quarter of 2020, the median home price was about $329,000. Now right now, Q3 2022, technically we're in Q4, but this is lagging. The median home price was $455,000. So first of all, your price of the same property is up that much. Fixed rate mortgages were $288,000 in September of 2021. Today they're $688,000. That is a huge difference in interest, just massive. So what would have cost you basically $1,500 a month to service now costs you $2,500. And so on a mortgage basis, like if you hold your mortgage for 30 years, your cost to purchase that same property, the same exact property, 2 years apart, basically, what is $538,000 or $836,000? That is a $300,000 difference that is paid in interest over 30 years. So a US home buyer now needs to earn $107,000 just to afford a median priced home for sale. That's up 45% over the past 12 months. Okay. So, and if your median cost of a home is up $126,000 and you have to pay an extra $1,000 a month after tax, so I grossed it up, about $16,000 more a year that you have to earn or somehow like pull it out of somewhere with inflation raging. This is why people are wanting to get their higher paying jobs. So your cost of insurance is also going to be higher. I mean, insurance across the board is higher. Your property taxes, which are based on your home price, are higher, not to mention what we're all paying for utilities. So it's, as interest rates have gone up, they will start to dampen, and they're already starting to dampen what was just out of control prices on homes. And they're still growing, mind you. They might be coming down a little bit, but in general, home prices are still going up. So the Fed is going to continue to raise rates, right? What you see here on the right, Fed funds futures. This is what kind of like Bloomberg terminal. There's a market. There's a forward curve, which is basically the bond market. So it's people, but we call it the market, that basically place bets on what the Fed is going to do. So even though we're talking about hard data in macro, what's ironic is that what you see happening in a stock market and the bond market, and you see all the headlines, is actually traders taking bets. This is actually what happens in the system. They take bets. So they are betting, and this is where everybody got it wrong in the beginning of the year. They were calling the Fed's bluff. The Fed was not bluffing. They're raising rates. So it took everyone by surprise. And so the markets that set the interest rates were taken by surprise. But you see here where it says up here 0.50, 0.50, 0.25, that is what the market expects the Fed to do. So there is an expectation that they will continue to raise rates, and then they might start to come down. They need to see inflation come down a lot. They need to see a recession in order for them to slow down, or what's called a pivot, which means to turn around and start to reduce rates. Now, by raising rates, they've given themselves room, once there is a recession, to then lower rates to try to stimulate the economy back up. This is how it works. This is what they do. And so you can see over here on the left that in this circle here, 2022, like that is how, like it's almost a vertical line in the speed at which these rates have been going up. Okay. So you probably all saw the headlines last week that CPI, that inflation came down. And it surprised, again, the analysts, the guessers, the professional guessers. It surprised them that it was lower than they were expecting. So again, if you remember that chart where we showed the different pieces, housing was still up, but other things were starting to move down. So it moved lower. Now, it's very good that it's moving lower. It's very good that it's moving lower. And you can see how high it went up in June. So what the Fed wants to see is they want to see inflation back to 2%. May not be possible. We'll see. Some economists, some analysts believe that the Fed will revise their target inflation to 4% annually because globally, what's going on geopolitically, the cost of energy is not going down. So it may not be possible to hit 2%. That just might not be reasonable target. So we'll see. That's hearsay. But these are the kinds of things that analysts and economists and investors look at because they want to try to understand how to make their moves. Like you want to be able to understand, well, should I borrow now or should I wait 18 months when the Fed should be reducing rates? So these are the kinds of decisions that get made based on macro and based on what's going on in the economy. So like I said, the Fed won't pivot. They're not pivoting, but they're going to slow their roll. And last month's data, we need to see inflation continuously come down. So November data, we need to see it come down. We need to see it come down consistently for the Fed to not do a 75 basis point rate hike in December. The expectation is 50, which would be good. But something that happened last week is that when the Fed said, or when CPI came out, the markets went wild. The Dow was up 1,200 points in one day because the stock market has been reliant on cheap money for over a decade to grow asset prices, to grow share prices. So the market, and the Fed doesn't want the markets to do that. The Fed wants everybody to slow down. The Fed needs these companies to start laying people off. And you're seeing it happen. You're seeing it happen in the tech sector, because this tech sector was the number one recipient of all this free money. Because any kind of tech or growth stock is based on forward earning. So you're betting that it's going to be worth something a lot later. So if it doesn't cost you anything to place that bet, I'm going to place that bet, because if it's going to, 50x in 10 years, but it costs me like 0.25% to see that growth, that's a bet I think anybody would take. And that's what institutional investors are doing. But if it costs you 4% to take that bet over that amount of time, you won't take that bet. And so the market, you're seeing investment managers move out of high growth and into something called value. We'll talk about that in a minute. So here's why the Fed won't pivot. We still have wage growth. This is really important. The Fed will continue to hike rates so long as there's a low unemployment rate. I know it seems silly because we all want jobs and we all think that like the more employment, the better. Not the Fed. The Fed does not think that, when it's matched up with all of these multiple factors that are making inflation what it is. So as wages outpace inflation, the guidepost is when it's the other way around. When inflation is lower than wage growth, we're not there yet. And so what you see here, and I'll talk about it later too, is that if your inflation is up here, but you got more wages, there's a gap. That's negative real wages. You're still not making enough money to meet inflation, to meet what it costs you in addition to what it was costing you before. So again, this erosion of purchasing power. So here's the unemployment rate. So again, in macro, employment is a massive factor. So unemployment did go up a little to 3.7, historically low, and the economy is beginning to slow. The Fed wants the economy to slow. We should start to see unemployment rise. We should. That's what they want. And it's really important for inflation, for all of us to get under control. And I mean, just this week, there's been Amazon layoffs. I think Facebook layoffs was last week. There's a bunch of layoffs in the prop tech, so real estate tech sector, tons and tons and tons. You'll see most of them in the corporate tech sector first. That's where you're going to see most of the layoffs, because that's also where there's been the most wage growth. We have to look at service sector jobs as well, right? Like where restaurants and et cetera. So we're starting to see the shift, but again, it's going to take time. So will inflation continue to ease? We saw it come down. You would think so, but this really caught my eye. Corporate leaders say they will keep raising prices. So will inflation continue to ease? Yes. Will our cost of living come down? I don't think so. So just really quickly, because I definitely want to get there. You were talking about this chart right here. What about those wage increases? So the nominal and the real, you can see here, if your CPI is up here and your wages are down here, that gap is still not enough. But some people have been able to go upwardly mobile with their wages and be okay. But in essence, if you aren't making money in excess of inflation, you're not making more money. We're really close to the end here. So in 2023, watch for inflation falling. Maybe some easing price pressures here or there. I would just negotiate the crap out of things right now if I could. Negotiate everything, because there's going to be this dichotomy of you're starting to see some spending is still up actually quite strongly. I think we're going to see spending come down real hard after the holidays. we should see, so there's stores that overbought. They have too much inventory. They're starting to put it on sale. Like Black Friday should be pretty good this year. We're gonna start to see interest rate hikes easing. It doesn't mean they're going away. Debt is gonna cost more, but they're just not hopefully gonna go up that high. But it all depends, because the Fed makes those decisions based on data. And so if the data comes in hot, they will continue to hike. So then housing market declines, we should see some easing of pressure on home prices, because if it costs you so much more to buy a house, you can't afford as much house. Therefore, your offer isn't going to be that high. And that is the relationship between interest rates and prices, is that if it doesn't cost you that much to borrow, you can borrow more. So you can get more house. So you can offer more. So that is going to reverse. I would be very wary of people, calling it a crash. We would have to see a massive recession to see any kind of really strong house price crash. Prices coming down is very healthy. They were up way too much. So we should all be cheering for slightly lower home prices. We'll see an increase in unemployment for sure. That's what they want. And that's what they're going to get. And I have here recession officially, maybe. And the reason that that's kind of cheeky is that technically recession is 2 quarters of negative GDP growth. And we might already technically be in a recession, but it doesn't feel like it for some people. There's a lot of people really hurting right now. It's like there's 2 economies almost. Because when I go out, when I'm trying, like the restaurants are full, everyone's spending, there's like lots going on. The consumer spending report that came out today was super high. People are spending. So the recession, we'll see. We might not start seeing headlines of actual recession until next year. So these are things to watch out for, but know that no one knows for certain. Nobody. The professional, guessers and gamblers of hundreds of trillions of dollars of global wealth, they don't know either. So we just need to do our best, check the data, find people that you trust, that have information that makes sense to you. And so what do we do with all this? What do we do with all this going into 2023? Make thoughtful adjustments. And something that Jennifer talks about a lot, we talk about this all the time. Check your variable rate debt. Make sure you understand how your debt works and how much you're paying, especially credit cards, especially anything revolving. I'm no longer using my home equity line of credit the way I was before, because it costs way too much. Not worth it. It's not worth it for me to pull out my money at that rate. For example, if I'm making an investment, that investment needs to return a heck of a lot more to make it worth it for me to use that debt. So important to understand if we're able to cover our debt service. Refocus your budget. Like really look at your budget right now. Like really look at the credit card statement. Like where is the money going? And what is going up the most? And then see if you can make adjustments to the spending so that it doesn't have to feel that hard. Prioritize paying off any high rate variable debt. Don't pay off low rate fixed debt. Inflation is going to do that for you. Just don't pay off your fixed rate debt unless it's like a lot higher than 5 or 6%. Banish shame and guilt. Okay, we're all paying way more money for everything. I am not happy with my credit cards either. But that's the world that we're in. So it's not that you're spending more, that you're out there doing the YOLO trade necessarily, but so don't feel bad about it because it's happening to all of us. We're all in the same boat. Really understand if you're going to expand your business, what it's costing you. And this is where building relationships with your bankers is so important because you can negotiate everything. Understand energy security. Energy security is a theme. It's a thing. We are not going to be paying less for anything energy related. This is a cyclical, potentially secular change that's going on right now. So understand that even though there's a lot of investment being made into renewable energy. It doesn't mean that it's going to cost less anytime soon, especially not in the next decade. So the slowdown in the housing market should aid in affordability. So prices should come down. Again, negotiate. But if your mortgage payment is too high, it doesn't help with affordability. So just something to think about. Always do your calculation. You shouldn't pay more than 30% of your gross income on housing costs. Invest. Okay, so you can still invest in this market. Plenty of places to invest. Non-correlated assets. So you can still invest in stocks, but very thoughtfully, very carefully. If you have a financial advisor or a group or community, the high growth tech sector is not going to be the darling at all anymore. But you can still invest in commercial real estate, risk management products, which is something that Jennifer specializes in, alternative assets, different kinds of commodities, and for the first time in a really long time, savings accounts and certificates of deposit. Shop your rates. You can get some pretty nice rates on savings accounts right now. So that's not a bad thing. They're not going to cover inflation, but it's better than we were getting 0.01% for the past decade. So just know that there's always opportunities for growth and gains. So other types of investment opportunities, for example, this just kind of talks about how a lot of managers are looking at energy. This is sector performance in 2022. Energy was the number one performer. So there's other opportunities. So we're moving into a value cycle. So something to think about. And remember your 3 pillars of wealth. Your public equity is just a small part of it. There's other places so that you don't have to be freaked out about what's going on in the very wild stock market, and the bond market are just not performing the way that they used to. And diversifying your portfolio. We talked about this a lot: real estate, private equity, not just stocks. And don't let the headlines scare you. So really focus on the fundamentals. Take time to get educated and informed. Reach out to trusted experts, advisors, professionals, financial communities, and get your financial foundation in place. Next month, we're going to be talking about financial advisors and the role that they play. So this whole year has been getting us ready to go into 2023 and really understand what's going on. And I'm going to put this might play. This is on the Get Educated and Informed. Ray Dalio, this 30-minute video, I'll put the link in here in a second, is worth it. It's worth watching. This is how we start to understand what is going on, why it works the way that it works, so that we don't feel disempowered, because it can feel disempowering that all these weird things are happening. You're like, what's going on? This is a great start. Ray Dalio, phenomenal at sharing his wisdom. So